How's it going, everybody? Welcome back to the channel. My name is Jay, and today we are looking at yet another dividend ETF. Today, that dividend ETF is ticker symbol DGRW, which is the Wisdomtree US Quality Dividend Growth Fund. That's a lot to say, so we're just gonna call it DGRW. We're gonna look at all the ins and outs of DGRW in this video, how it selects its stocks, what stocks it holds, what it charges you to hold the fund, and everything in between. So I hope you'll stick with me to the end of this, and if you find anything in this video helpful, please hit the like button on the video down below. It really does help the video and the channel out. So DGRW, DGRW, how does it select its stocks? And there is quite the selection process to decide what stocks DGRW will look at, and finally, which stocks DGRW will actually hold as part of the ETF. So first, let's start with the selection criteria. To be eligible to be held in the DGRW Dividend ETF, a stock has to be a large cap stock traded on a US exchange. A large cap stock is defined as having a market cap or valuation of $2 billion or more. Secondly, that stock has to have paid a dividend within the last 12 months. I mean, it wouldn't make much sense to have a dividend ETF if the stocks didn't pay dividends, right? Next up in the DGRW screening process is a liquidity of $200 million over the past 3 months. So with that, they just want to make sure that any stock included in the ETF has a sufficient volume and they're not going to get stuck holding the bag on anything or unable to trade it. Next up, they want the earnings to be greater than the dividend ratio. In other words, they're looking at the payout ratio and they want that to be under 100%. Now, if you remember back to the video where I gave you my personal dividend screening criteria, I look for a payout ratio of about 65% or less. So for DGRW, they're looking at 100% or less. Still good, because once you get into the payout ratio over 100%, that's when you start getting some stocks that have really unsustainable dividend payouts. And finally, an important note, DGRW does hold REITs, which does differentiate it from a lot of other dividend and income ETFs we've looked at in the past. And it also holds ADRs. ADR stands for American Depository Receipt, and it's basically a way for foreign companies to be listed and traded on US exchanges. That's why it's important to note in that first bullet point we listed stocks traded on a US exchange, not US stocks. So the inclusion of REITs and ADRs really separates DGRW from a lot of other dividend ETFs that are out there. That's how they screen the universe of stocks for ones that can possibly be selected for the DGRW ETF. Now, how do they take those stocks that meet that screening criteria and actually select the ones they include in the ETF? And to do that, they score the stocks based on 3 metrics. The first one ranks the stocks based on their long-term estimated earnings growth. This is essentially ranking the stocks by analyst forecasts of what they predict the growth of the company will be over the next 12, 24, 36 months. And the DGRW ETF looks at that and ranks it first, and that's because this is a dividend ETF that's looking for companies that are high growth companies that still pay a dividend, rather than your stodgy old dividend payers that pay out a steady dividend but don't offer much in the way of growth. Then the second metric they rank the stocks by is actually one of Warren Buffett's favorite stock metrics to look at, and that's the return on equity of the companies. And for DGRW, they're looking at the 3-year average for the return on equity. And along the same lines, the last metric they will rank the stocks by is the 3-year average of the return on assets of that company. So they take all those screening metrics, they rank the stocks by these 3 criteria, and then they select roughly the top 300 stocks to actually be included in the DGRW ETF. Now, I think they aim for 300 stocks, but currently DGRW only holds 266 stocks. So that's how DGRW works and how the stocks are selected. Next up, how do they decide the composition of the ETF? What stocks get weighted the most heavily? What stocks do they only hold a little bit of? And again, there are a few metrics that DGRW uses in order to rank the stocks and how they weight them within the ETF. And the first thing they're looking at is the future dividend yield. Again, if you look at any of the literature that Wisdomtree puts out on the DGRW ETF, they're really hammering home, this is a forward-looking ETF. We're not looking at past performance, we're looking at what companies are going to do in the future. So that's why they're looking at the future dividend yield. They care about the dividends these companies are going to be paying out going forward, not the dividends they paid out in the past. So that's their first ranking metric, and they're going to cap that at 12% yield. The next way they balance and weight the composition of the fund is any one sector can only make up 20% of the overall ETF. I mentioned a little earlier how DGRW does include REITs as part of its composition, and a lot of other dividend ETFs don't. DGRW does limit the amount of REITs it can hold though, as just like any other sector, REITs can't make up more than 15% of the overall composition of the ETF. And finally, any one individual stock is capped at a maximum of a 5% overall weighting in the fund. So by limiting how much the sectors, the REITs, and any one stock can make up in the ETF, DGRW tries to keep a balanced and diversified group of holdings. Which brilliantly leads us into what are the top holdings of the DGRW ETF? And as you can see, the current top 10 holdings of the DGRW ETF are on your screen right now. We have a lot of familiar names. We have traditional popular dividend payers like Johnson & Johnson, Coca-Cola, Pepsi. We have some high yielders like Verizon and Altria. But what might be a little shocking is the top 2 holdings of the ETF, Microsoft and Apple. Now, Microsoft and Apple are very common top holdings of a lot of index funds and a lot of technology funds, but they usually aren't up there in dividend funds. And that goes back to the core strategy of what this DGRW ETF is all about. They're looking for dividend payers that offer growth. And while companies like Microsoft and Apple may not have huge dividend yields, they do still offer a lot of growth, and they do offer a lot of dividend growth. So those are the top 10 holdings of the ETF. They make up just under 40% of the total holdings of the ETF. And while you see Microsoft is currently a little above that 5% threshold, the fund does rebalance and reshuffle its stocks yearly in December. So as I record this, that's only a couple months away, so I'm sure they'll get that sorted out shortly. So we've gotten through the nuts and bolts of how DGRW works and what it holds. Let's get into how does it perform? Because I don't care about any of that other stuff if the fund doesn't perform, right? First up, let's compare it against the total stock market index, VTI. And as we might expect, even though this is a growth-oriented dividend ETF, it doesn't quite keep up with the total stock market in terms of overall performance. Over a 1-year period, it lags VTI by about 10%. And when we zoom out to a 3-year time horizon, we lose a little more ground, and DGRW lags VTI by about 15 to 16% over the last 3 years. But the total stock market isn't an apples to apples comparison, you might say. So let's look at DGRW against another straight up dividend ETF. And we'll look at one I like and I hold, and that is SCHD. And when we look at DGRW versus SCHD over a 1-year time horizon, SCHD comes out way on top by almost 15%. When we expand that to a 3-year time horizon, DGRW closes the gap just a little, but it still underperforms SCHD overall by about 13% over the last 3 years. So we can expect a dividend ETF to lag the overall stock market. That's fine, that's probably to be expected. But to see DGRW lag SCHD so much, that's not a good sign, and that is a big red flag for me, especially when DGRW is touting how it's looking for growth and growth-oriented dividend payers. To lag on growth by that much is really not a good sign for them. There are a lot of things to like about the DGRW ETF. I like how they focus only on quality holdings. They're focusing on stocks that promise future growth and have a current competitive advantage. It's a well-diversified ETF. It holds 266 different stocks currently. That's a lot different than something like SCHD, which only holds 100 stocks, but it's not quite as diversified as something like VYM, which I think holds a little over 500 stocks. And maybe the biggest pro to a lot of you out there is DGRW is a monthly dividend payer. That means you're going to get a dividend every month if you hold this ETF. That separates it from something like SCHD, which does only pay quarterly dividends. So if you prefer monthly dividends versus quarterly dividends, maybe DGRW is worth a closer look to you. Now, some of the negatives, in my opinion, I don't like how there's no dividend growth requirement as part of the fund's screening criteria. All they care about is that the stock has paid a dividend within the last 12 months. When I invest in dividend stocks and when And what I look for in dividend payments is I want that dividend payment to be ever increasing. Maybe that's not so important in an ETF where they can shuffle in and out its holdings, but not to have that requirement at all is a little bit of a con for me. The DGRW expense ratio is 0.28%. Now 0.28% is something I'd probably call okay, it's acceptable. It obviously doesn't compare with something like SCHD, which has a 0.06% ETF, and for being passively managed, it might be a little high at 0.28%, but it is well below most actively managed funds, which are usually at 0.6 or 0.75%. And it's well below my general rule of thumb that I won't even look at anything that's over a 1% expense ratio. And another con to the DGRW ETF, one which you might have been able to sort out when we looked at the top 10 holdings, is it has a low overall dividend yield. The dividend yield of DGRW is only 1.78% right now. So you're not going to be getting much of a current payout when you hold this ETF. And again, it tries to focus more on growth companies that pay a dividend, so a little lower yield is to be expected. But again, when you're underperforming another ETF like SCHD, which is providing more growth, and comes with an almost 3% dividend yield, I'm not really seeing why I should choose DGRW over something like SCHD. And I think that's where I come down on this. DGRW on its own looks fine, but when you start comparing it to some competitors, it falls up just a little short. Now, if you missed my entire video where I went in depth on SCHD, you can find that right over here, along with all the other dividend ETFs I've covered. I hope you enjoyed this one. I hope you enjoy those, and I hope to see you in the next one.